You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program where we break down the sometimes scary, sometimes just intimidating, sometimes just impenetrable world of options for you, the busy asset manager, financial advisor who's you got other things on your mind. You're busy dealing with your clients and watching the markets. You don't maybe have time to learn about a new marketplace, but maybe you're curious. Maybe you want to dip those toes. Maybe you already have done so. Maybe you need a little help. Either way, we've got you covered. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Joined on the old program today. Let's go around the horn as we like to do. Let's follow the dial of the clock there, and let's go all the way up to a little bit past noon, maybe around a 1 or 2 p.m., where we land in a little quiet, sleepy area known as New Hampshire, where we are joined by Mr. Matt Amberson, the principal, indeed the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the keepers of all that cool earnings data you guys love. Matt, welcome back to the Advisor's Option.
Thanks, Mark. First day of spring, and it's beautiful here in New Hampshire. Looking forward to some warmth and thawing out, but we don't need to talk to Chris about that.
I thought you guys in New Hampshire, I thought you'd go up there for the cold. You don't want the warmth, right? Whenever I talked to your buddy Andrew over there, I stayed over in Maine, he doesn't want his ice rink to melt.
We like it. It keeps the riffraff out, but not too many people make it up here. But we need some vitamin D on our skin up here. Andrew is kind of that pasty white, and he's way up in Maine. I'm down here in the tropics in New Hampshire.
The tropics of New Hampshire. All the coastline of New England, right? All in New Hampshire. There you go. Like we got, 3 miles of it, something like that. All right. And then let's talk sunshine. Let's talk coastline. They got a ton of it where we're going. Follow that dial all the way down and out a little bit, out into the Atlantic, where we are joined all the way to Puerto Rico, scenic and sunny Puerto Rico, where we are joined by Mr. Chris Hausman. He's a portfolio manager, a.k.a. the managing director of risk, a.k.a. the director of risk over there at Swan Global Investments. Mr. Risk Director, how are you doing today, sir?
Mark, always a pleasure to be on, and I believe today is about the 80th day of summer for the year, something like that. I may be off a day or two.
Yeah, well, when every day is like 82 and sunny, who can tell, right? I was just down in your neck of the woods, not too far away on the east coast there of Florida, and it was pretty hot last week. I got to say, it was pushing 90 some days. So you guys are getting the warmth down there. Not so much in Chicago, even though it isn't bad this time of year, pushing the 50s now, which is pretty good. Meanwhile, though, let's move out of the weather reports and into our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down these scary options instruments and tell you how you can utilize them in your clients and indeed your funds portfolios out there. And this Options 101 kind of is a bit of a spin-off from the one we did last episode. Remember, we did a bit of a deep dive into straddles, the pros and cons, the use cases, the lack of use cases sometimes when you shouldn't use those things. And at the end, we had a little bit of a conversation about how you could upgrade those straddles. And it got the wheels spinning. It got us talking about interesting things you could do, different legs and different things you could add on to maybe expand upon the straddle. And it got us into the spreads that are iron. And we thought, it's a fun topic to explore. And hey, Game of Thrones is coming back, Iron Throne, Ironborn. Let's talk iron stuff. So we're going to do it. We're going to talk iron versus iron today in the Options 101, a.k.a. the Iron Butterfly versus the Iron Condor. Two popular strategies, different but similar use cases out there, different but similar performance type of characteristics. So worth, I think, a little bit of extra time on here. Let's start off with some basic definitions. Again, these are some of the more intimidating terms in the option space. People hear Iron Butterfly, they think of that crazy band and that song from way back in the day, right? And they think Iron Condor, there's no appropriate metaphor for that. They just think, what the heck is an Iron Condor? So we'll break it down. These are old school terms, very scary, I know, somewhat impenetrable. But Iron Butterfly is kind of, like we said, a bit of an upgrade to the straddle we were talking about last year. Remember that straddle, typically an at-the-money call and put, either bought or sold at the money, so one of each. And then if you buy it, of course, you're going to be long the premium. If you sell it, you're going to be short. Now, the Iron Butterfly adds an extra leg to that. So let's say you buy the straddle, and again, you're worried about decay. We talked about that in the last show. It's one of the chief dangers of being long straddles. Well, you want to sell some legs, and that's what the Iron Butterfly does. It sells a strangle, which is, remember, just an out-of-the-money call and out-of-the-money put against that at-the-money call and put you bought on the straddle, and vice versa if you sold it. So if you sell the at-the-money straddle, you're going to buy the out-of-the-money strangle, and that allows you to mitigate your risk. And that's effectively all an Iron Butterfly is. Very scary name, not so intimidating when you actually look at it. Now, the performance could be a little bit intimidating, but in terms of understanding it, it's not as scary as the name would imply. Now, the Iron Condor are a little bit different, taking a bit of a back seat, a step back from the straddle, if you will, because maybe straddles are a little bit scary for you. Maybe they're a little bit intimidating. You don't want all that crazy at-the-money madness, all that gamma, all that theta decay. You don't want that. You want to get a little bit away from that. That's what the Iron Condor is for. It's going to move you back. It's going to, instead of doing it at-the-money straddle, we're going to spread it out. You're going to buy or sell, and out of the money, slightly out of the money, strangle. Maybe, let's say for purposes of our example, maybe 5% out of the money. So now what is that? Instead of having at the money where every tick the underlying moves you're going to make or lose money, now you're out of the money a little bit. So it's going to be, your impact's going to be a little bit more muted. You're also going to be not decaying as rapidly as if you were on the at the money strike. Now, if you're long premium, it's a good thing. If you're short the strangle, maybe not. Maybe you want that to decay a little bit faster. And then now you have that one strangle. You're not done there. You want to make sure you protect yourself against extreme moves if you're short it, or if you're long it, you want to maybe get some of that premium back. So you're going to, let's say in this case, you bought the out of the money strangle, let's say for our purposes, 5% out of the money. Now you're going to turn around and sell a farther out of the money strangle against it to get some of that premium back. In our example, maybe 10% out of the money. So now you have effectively a long iron condor that is a long 5% out of the money strangle and short a 10% out of the money strangle. So you can see exactly what that is. It's effectively two verticals going on in different sides of the options chain there. You have that nice call vertical on the upside, that nice put vertical on the downside. So you can think of it a couple of different ways. But at the end of the day, it's taking a bit of a step back, removing yourself from the at the money conflagration that is the straddle when you're talking all the dangers there. And with the iron butterfly still lives there, the iron condor, not so much. All right, let's go around the horn. These are two very intimidating terms, sometimes scary. That's why we save them for a little bit later in the show. Now you've been doing it for a while. We don't think you'll scare you guys away. We don't want to talk iron flies, iron condors in the first episode because you'd go running for the hills, and I wouldn't blame you. Maybe we'll start. Let's go back the other way. Let's go back around the horn to the director of risk. Mr. Director of Risk, I know you're not probably slinging a lot of iron flies and iron condors over there day to day over there at Swan, but in general, what are your thoughts on these two strategies, their use cases, maybe their scenarios where you wouldn't want to use them, maybe comparing them back to the straddle? What's top of mind for you when you're thinking of these two positions?
Well, I think it's a good progression when you're learning about options, moving away from call spreads and put spreads. I mean, we obviously learn, just calls and puts. Then we turn that into call spreads and put spreads. And the next thing would be trading multiple call spreads or put spreads, right? Which means you're just trading iron butterflies, iron condors. And yeah, if you go back to straddles, well, that's again net units, and those can have the most risk. Either, if you're short them, you're going to have gamma risk, or you're going to have a lot of theta risk and time decay risk if you're long them. So one way to lessen that risk and turn, unlimited risk profiles into a limited risk profile is just turning it into an iron butterfly or an iron condor. So we do use them here. We don't use them necessarily as a pure income producing vehicle like a lot of programs do out there. But what we do is, up and down the risk spectrum, we'll see where parts of our risk curve looks a little bit weak, and we kind of use them to plug in those holes a little bit. So the thing about an iron fly or an iron condor is, well, you have a specific agenda, meaning you need the stock to be at a specific point, at some point in time to make money. And I think that's the hard part about flies and condors is, you need a range-bound market. And I think that's been kind of one of the challenging things with these vehicles over the last 10 or so years. They did very, very, very well for many, 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 many years. And I think, since about 2011, 2012, it's kind of been a challenging environment for doing at-the-money flies and condors. So I think, we always learn about the at-the-money structure, but keep in mind that you can use these tactically as well if you have an overbought or oversold condition where you can kind of, pick a price target, using whatever methodology you're using.
Matt, same question for you, your kind of general thoughts on these two positions, maybe comparing and contrasting your use cases when you like to use them, when you don't like to use them. Maybe I'll add an addendum for you as well, because as I mentioned earlier on the show, these are very intimidating names. I'm always trying to figure out ways to make them less intimidating, more approachable. So what do you think is a less intimidating way to describe the iron condor? You think is strangle versus strangle? That could still be kind of intimidating, or is it effectively the two verticals? Which do you think is less intimidating, sir, for a newcomer?
Yeah, I like to think of them as two out-of-the-money verticals, credit spreads. And, so then you can think of it that way. And sometimes it's interesting to deal with them on their own. If the stock rallies, maybe you put on a short call spread. If it falls, maybe a short put spread. And, just as far as my preference, well, even back in my trading days when we had a lot better capital margin requirements, we always tried to be what we would call flat units. So we don't want to be short an option versus another option. We want to always have at least a flat position. So, always managing your risk, and that's how you don't make as much money, but you don't get carried out either. So, shorts. I'm thinking about these straddles. Mostly about the short side. A lot of people are using, especially the iron butterflies, to collect premium. So you're short a straddle and long some wings against it. That's how I think about it. And then the iron condor just spreads out that straddle to a short strangle, and you still have those little wings on the outside. And then, so that's the basic. I mean, we could talk about backtesting and about certain things later, but that's the way I think about them, Mark.
Well, let's get into some of those fun metrics and that fun data, because you're right. These are intimidating names, but they're also maybe can be a little bit intimidating as to when the proper use case arises. Straddle, like we mentioned on our last show, they get a lot of love in the late night infomercials, sometimes inappropriate love in terms of what their use cases are for. They don't talk about what they shouldn't be used for. Iron flies, iron condors, they have wings, they have legs, they give you a little bit more nuance, a little bit more room as to when you would and maybe would not use these strategies. So, Matt, you're the keeper of the data over there in the land of ORATS. What are your thoughts on the efficacy of either of these two, and maybe when you wouldn't or wouldn't want to use them, sir?
Right. So let's look at it from a short straddle and a iron butterfly with a short straddle, and the iron condor with a short strangle, basically. And so as you're going up that food chain, so to speak, you're giving up some overall annualized returns. You're taking less risk. That's a rational way to see what's happening to these positions. I never abdicate the short straddle alone. It often makes a lot of sense to be able to put on those small wings. And when I say wings, maybe if you think about it from a delta perspective, where the at-the-money delta is a 50 delta, and you might buy a 10 delta, it might be, I don't know, something like 20% out of the money, depending on how many days to expiration that you're looking. And mostly, speaking of days to expiration, we test a lot of these. And the sweet spot seems to be about a month, 20 days to a month, I'd say. If you get less than that, you don't get as much premium, and you could still see some pretty violent swings that will cost you a lot of money. So the sweet spot in the days to expiration, like I said, 20 to 30. As far as the sweet spot in the strike selection for the wings, let's just say, for the iron butterfly, those are about a 10 delta. If you get less than that, then you don't get the protection, and you're going much farther out. Closer than that, you're giving up too much of the premium that you're collecting. So, that's the sweet spot that we see. As far as the iron condor, mostly we're testing something like a 30 delta and a 10 delta. So you're short the 30 delta calls and puts, and you're long the 10 delta calls and puts. Obviously, a put is a negative delta, but just absolute deltas, just to communicate. As far as returns, we at ORATS we calculate absolute notional returns, which means we divide how much ever we make on the option by the stock price, and so you can compare it a lot easier that way. But that penalizes the iron butterfly and iron condor that actually have limited risk, so they have much more efficient use of margin. But basically what you will see is something like you might make 5% a year on the short straddle. You might make 3.5 or 4 on the iron butterfly, so you're giving up about 1.5% on those long legs that you're buying. And then on the iron condor, as you spread out, you're giving away another couple percent, so that's about a 2% on average. However, the drawdowns are what are interesting. So a drawdown is when you start losing money, and before it turns, how far did it get? Could be multiple months. So a short straddle, the drawdowns that we typically are seeing is about 25%, 25% of your capital, and on the iron butterflies, only about 15. And then on the iron condors, about 8. So the 8 is not a bad drawdown if you think about it. However, you're not making a ton either. So I wanted just to start off and give you those metrics, and then Mark, if you want, we could talk about some ways that we've varied these tests. Well, why don't I just get into those right now? Really, the bottom line is that we've tested exiting, using exiting on profit amounts. I know that's somewhat popular out there, but what we're finding is it's not quite worth it. It's just basically set it and forget it. And what we did like to do, however, is stagger some of the iron butterflies. So, for example, let's just say you were going to trade a 3 lot of iron butterflies for a month. You might do one every 10 days, and that smooths out your strikes, so you're not as what's called path dependent. So if the stock is moving around, your strikes will be spread out as the stock moves. And so those are really the findings that we have from running thousands of tests. Mark, is the short straddle, larger drawdown. I don't know if it's quite worth it with the 1.5% more that you get from an iron butterfly. Iron butterfly seems to have a much better return structure than an iron condor, and the drawdowns are, well, albeit more. You get a much better result, Mark.
Yeah, that kind of is pretty much in line with what I was thinking. Interesting though about the not taking it off part. That's kind of interesting. It just juice wasn't worth the squeeze there at the end. Kind of the old Ronco era, set it and forget it type approach. That's what worked best in your back testing there, Matt.
I have a Ronco pasta maker. It was one of my favorite pieces of machinery. So set it and forget. You got to listen to those guys, Mark. Set it and forget it.
See, infomercials. That's where all the options wisdom truly comes from. Who knew that Ronco was the mecca for all options wisdom? But that makes sense. You're getting a little bit more heat, a little bit more danger, being that that close to the at the money with the iron fly. But it sounds like it perhaps is worth it if you can live with a little bit of that extra heat. If you don't mind being that close to the kitchen, that close to the flame, then maybe the iron fly is the choice for you. But remember, set it and forget it. Mr. Chris, a.k.a. the Director of Risk, any of this data surprise you, or is it kind of in line with what you were thinking? And any other thoughts you want to share on the perpetual iron versus iron battle of the iron condor versus the iron fly?
No, it's pretty much in line. I think staggering trades is also a big plus. You want to try to reduce path dependency as much as possible. I think that's very important with this kind of strategy. Just some basic advice: if you're new into iron flies and iron condors, just kind of make sure you're correct about whether you're buying the wings or selling the wings. I have seen many out trades where, that people are buying the fly and they think they're buying the wings, selling the middles, where in fact they're doing the opposite. So it doesn't take much to just verify which way you're going on the wings versus the middles. And also, if you're trading European type products, which are cash settled, like an index such as the SPX, if the word iron scares you, you can always just do a regular call butterfly or a regular put butterfly. It'll have the same risk reward properties.
Maybe we'll have to do a follow-up segment on just regular old butterflies. But since we started talking iron last episode, it seemed appropriate to go into those. And yes, you're right, Chris. It is appropriate. You remember, when you're pricing these listeners, when you're analyzing them, you're going off the meatier inner wings, a.k.a. the guts. That's what we used to call them, the guts of the flies or the condors out there. So in that case, it would be the at-the-money straddle when it comes to the iron fly, or it'd be the closer to the money strangle in the iron condor. Either way, that's where you're going to key off of in terms of your buying and your selling. Interesting stuff. You guys have hit us up with questions. I'm sure you'll have questions about these as well. You know where to get them at us. Maybe we'll even get to some of them by the end of the show. Meanwhile, let's keep on rolling with a little bit of the old buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
right, welcome to The Buzz, the portion of the show where we break down the news from the world of options and options-related developments that maybe you missed. And it's interesting these times. We're in some interesting, somewhat turbulent, somewhat interesting times in the marketplace and in the options world, and from a volatility perspective, certainly. So I thought we'd start there, kind of giving you our thoughts, recapping what's been going on in the world of options and volatility since the last time we all gathered together here on the program. We've seen a lot going on. We've seen a market resurgence in volatility. It started to tick up across most of the broad equities and indeed a lot of the commodities as well. Uncertainty about the trade war, a bunch of other things were conspiring to drive that volatility up. And in the last week and change, we've seen, particularly on the equity side of the space, a lot of that volatility start to come in fact, come in very aggressively. So we've seen effectively a tale of two very different volatility regimes over the course of just the last month since our last episode. So these are interesting times. It could be challenging times for you out there managing your options portfolio as well. So I thought we'd start by going around the horn, giving you our thoughts on the past month. Let's go back the other way. Let's start with the director of risk. Chris, what's the last month been like for you as you're out there looking to harvest some premium on the near term and roll protection on the longer term? What's this turbulent volatility marketplace been like for you?
Well, continues to be turbulent. Every time people think we're in a new regime, a month later, people are saying, well, no, we're not. We're back to the same old, same old. So, obviously the market's been rallying, volatility's been coming in, but I will note there have been several days here where we're having rallies and we have overriders coming into the marketplace and rolling their short calls. So that's actually keeping volatility a little bit firm, across the strike spectrum. As the market blew through 2,800 on the S&P 500 here, we were in that big trading range of 2,600, 2,800. That's when I really started to see the volatility get hit, and also starting to see in the longer term spectrum. I think the carry in the long term vol has done very well this year thus far, but we are seeing it soften up over the last few weeks, definitely with the move outside of 2,800. And the Fed just minutes ago said, well, they're not going to raise rates for the rest of the year. I don't quite remember in March where they were already telling me they were not going to do anything with interest rates for the rest of the year. So I think they've are being as accommodative as possible, and probably opened up the door to test new highs here. So you should see further pressure on volatility if that happens.
Yeah, I think they realized, like the rest of the world already knew, that their gun was kind of empty. They didn't really have any more bullets. So they kind of confirming. When the rest of the world is talking stimulus, it would be kind of strange for the Fed to be continuing to talk hikes. Matt, same question for you. What's been top of mind for you and your clients over the past month? Have you seen volatility coming back in and then coming off equally, if not more aggressively, in the last week or so?
Yeah, it was quite a month for our signals. So we produced these signals, contango, and where is the front month versus the back month, and we look at that intraday. We got an interesting signal on early in March 4th, I believe it was, the Monday. The market had a big open, high, low, close range. And, we let a few of our clients know, hey, listen, we're seeing some contango go near backwardation. This is usually not a very good sign. And, the market started to tumble, and, we thought it was going to be somewhat significant. But then all of a sudden, the near the end of the week, the contango kind of surprisingly came back in, and the market has rallied since then. So it looked like an event was going to happen. It looked like we were going to test some lows, but then it just it turned around. So it's been a tough market for some of the signals. It's been choppy. There's been the strength has been there. I could tell you, though, it's starting to feel a little bit kind of toppy to me, and we're starting to see some volatility relationships, maybe not the overall level, but the relationships are looking a little bit like they're some early warning signs, Mark. So it's been a resilient market, but we keep a wary eye on. You got to be long the market, it seems like, but you got to have protection. And as we know, protection is expensive. So what we're trying to do is figure out when you could do the protection without, by trying to figure out if the market is worth the risk or not. And so, it's been a little bit tough on that regime. But we did have a pretty good call, like I said, early in the month, but it didn't pan out as far as going down as far as we may have. But and starting to soften up a little bit here. It'll be interesting next couple of weeks to see what's going on, Mark.
Yeah, it is kind of interesting. We're in this moment now where is the sell-off in vol, is it overdone? Is it maybe time to revert? Because we have seen this pretty much throughout the year. Products like VXXB, we see this a lot on our volatility show. A lot of the audience loading up on trades south of the 30 handle, and it never could make it throughout the entire year. It would hit 30 and bounce and bounce and bounce. And we saw a lot of people lose a lot of money on that trade over the last quarter. And now this past week or so, for the first time, it's broken through that 30 handle fairly aggressively. I think it's hanging out right now right about 28 3/4 or so. So substantially south of 30, which again indicates that volatility has come in aggressively over the past couple of weeks. So it is in that point where maybe you're right. Maybe it is time for the worm to turn, as they say, because there are still quite a few unknowns lurking out there in the ether. Let's see how all this volatility translated into the market for February in terms of the options business. Remember, it's been an ongoing source of debate for us and for questioning for you guys out there whether we could top the record 5.1 billion options contracts that traded hands in 2018. And a lot of our audience, the overwhelming majority, 75% of our audience said at the beginning of the year that yes, 2019 was going to blow the doors off. I was a little skeptical. I think a few of our co-hosts on the network were kind of skeptical as well. We kind of know what it took to get there in 2018. Didn't know if we could have that same confluence of events, that same just Sturm und Drang driving the market for 2019. And so far, the last few months have borne that out, unfortunately. And February numbers are in here. February's volume down nearly 26%, 25.9% from February of 2018. Year to date, their volume was down nearly 19% compared to 2018. Listed options, that's the main game over there at OCC. 349 million contracts in February. That was down nearly 25% from the period before. Equity options, drilling down a little bit farther, 316.3 million contracts. That's a 20.5% decrease from February of last year. If you drill that number a little bit more, cleared ETF options, 119.2 million, down nearly 40% from, again, February of 2018 was a very turbulent time, but still 40% decrease in that volume. And index options, to drill down even farther, index options down 51.1% from February of 2018. So a lot of wreckage out there so far for the year in the option space. Futures also representing that as well. Remember, futures cleared by OCC, primarily in the VIX futures land, so volatility, and they were down 61.5% from February of 2018. So far, a couple of months under our belt here in the year. And again, not looking favorable. But again, we polled our audience again after those numbers came out and said, are you still bullish on, do you think the options business can do it again in 2019? And again, I think even more, 76% said yes this time. So I don't get it, Matt and Chris. Our audience is super bullish. I'm happy. They're super bullish on volume anyway. Maybe they don't realize that when they're super bullish on volume, that means they're also super bullish on a whole heck of a lot of volatile events coming and rocking the market over the course of the rest of the year. But do these numbers surprise either of you? Or maybe the fact that our audience is still so bullish on overall volume, does that surprise either of you, Matt and or Chris?
I'll go ahead and jump in. I mean, I'm not surprised by the option volume decrease this year because remember what happened last year. It's February, we had Volmageddon. So that was going to be a pretty high watermark to try to keep up with, especially, with the rally that we've been seeing this year. You usually have decreased volumes on rallies. So no, I mean, volatility's down. When volatility's high, I mean, people are trading, and trades lead to more trades, and that's what you had back in February of 2018. So it was a totally different type of month this year. So maybe I'm a little surprised about the quantity, but I'm not surprised that there was, a decline. There should have been a decline.
Matt, are you equally unsurprised by that data?
Yeah, that was such a crazy February of last year that I'm not surprised about that. And it continued too, and there was so much upheaval. I went back and listened to one of our podcasts, and there was a lot of uncertainty, a lot of upheaval, a lot of trading. I think we're going to have an awful tough time surpassing $5 billion this year, Mark.
Yeah, that's the way I've been leaning. Our audience continues to lean the other way. So, hey, I in many ways, I hope they are right, but also I'm not looking forward to the many systemic shocks that it will take in order to achieve those volume levels. Speaking of volume and data, Matt, you guys are the keepers of data over there at ORATS, and we're kind of coming to the tail end of earnings and earnings volatility season. Again, our audience loves cranking through the earnings move and earnings move results reports. Now that we've seen the lion's share, the big names coming out, has any trend really resonated? Anything resonated with you overall net on this cycle, Matt? And I know our audience is going to ask this. We give them the answer every time. The answer is always pretty much no. It's pretty much a 50-50 in terms of how they perform, but they're going to ask, so I'm going to ask you again anyway, which is, what was the winner this cycle? Was it long or short premium? So if you have any thoughts on either of those, sir, the general thoughts, takeaways from the cycle, and if there was a winner, which was it?
We are back to our normal 60% selling winners and 40% buying winners. The only quarter that I can remember that was out of that range was 45% buy winners and 55% sell winners. That was the last quarter when the volatility was so high. So we're back to normal. Our signals are working okay. It's been a little bit difficult to map the market out based on how the last earnings season was so odd, because you had earnings piled on top of an extremely volatile month. So it's been it's caused us, when we're looking back, how does this compare to past months? It's a little bit difficult. Some of the signals that worked well in the past, aren't working as well this quarter. So we're having, I would say, a disappointing predictive quarter, but the new normal is back, meaning it looks like the underlying market that caused so much havoc in that last quarter is kind of out, and we're back to kind of a normal earnings movement environment now, Mark.
That's good to hear, and it's worth noting when you hear those numbers, 60% of premium sellers win and 40% of premium buyers win, so I should lean dark side. Of course, it doesn't take into account when you lose on the dark side, you lose pretty hard. So that's going to wipe out a lot of the other gains you made. So we've said it before, we'll say it again. The really earnings season, trading through it is still pretty much a crapshoot. You could trade around the event and the lead up in the immediate aftermath. We talked about that many times. I think Matt in particular has advocated for the latter, trading in kind of the aftermath of it. But through the event itself, it's like you're riding that barrel over the falls. You don't know what's going to happen. You're just at the whim of gravity. In this case, you're at the whim of the market. So bear that in mind when you hear this data. All right, let's move on to other news, other big stories making news really in the world of options and derivatives. This seems to rear its ugly head every couple of years. It's particularly resonant to this audience because I know this audience is extremely tax sensitive. We have a new bill, a new transaction tax bill, gentlemen, making its ugly head. They keep tilting at this windmill. They keep trying it. Now that there's this new, extremely aggressive, progressive wing of the Democratic Party, it seems like they're going to want to try this again. That's exactly what we're seeing. We're seeing a bill coming out of the Senator Brian Schatz out of Hawaii and Chris Van Hollen out of Maryland, as well as Representative Peter DeFazio out of Oregon. And they're announcing a new transaction tax for the sale of stocks, bonds, and derivatives. So what they want is 10 cents per $100 of transactions, aka about a tenth. 10 basis points, obviously. So looking here, and the language used to describe this is pretty impressive. They say their bill would create a new quote-unquote progressive tax on financial transactions as opposed to all those other regressive taxes we've had for years. And they go on to say that would generate billions in revenue while addressing economic inequality and this is the best part, and reducing high risk and volatility in the marketplace. They say they want to address the disconnect between the financial system and the real economy by reducing unproductive and speculative trading. By increasing transaction costs slightly, the bill will help redirect investment that has flooded into areas of has flooded into transactions without economic value into more productive areas of the economy. It will also reduce the risk of financial crashes and limit the risks that high-speed arbitrage pose to our financial system. Again, they say they want to tax trades 10 basis points. They think it's going to raise an estimated $750 billion over the next decade. And for derivatives, they want to tax because obviously they're going to do the fair market value of the trade for equities and bonds. For derivatives, they have the payment flow. So I'm assuming they're going to tax that off the premium flow, not the notional value or something along those. You never know with these types of bills. Let's see. They say risky financial behaviors and near instantaneous high volume trades have destabilized our financial markets while contributing nothing to the economy. They want to rein in excessive speculative activity and protect working families from these dangerous practices while maintaining appropriate market liquidity. It goes on and on with this kind of language for a while. I will note that the folks at SIFMA, who was one of the regulators, have come out with a little bit of a saner view on this. And they note the data, because the data is overwhelmingly against these types of ideas. They say the data argues that major economies that have adopted such taxes have had overwhelmingly negative results, including reduced asset prices, trading moving to other venues, market dislocation, and the exact opposite of what they want, decreased liquidity. And past experience also suggests that it would raise less revenue than supporters often claim. So there's a lot to unpack. Again, we've seen these before. Thankfully, they've all died on the vine, never really made it out of committee. This one seems to have a little bit more muscle behind it. Obviously, we talk to a very active audience and a very active audience of advisors who manage their money. So we lean towards that side of the spectrum in terms of that. But we've seen this data before. And the notion, and it sounds so simple, it sounds so easy. Tap a little tiny tax on these transactions. What could be the harm? And then they're going to take this and funnel it. Apparently, they don't really say that in the language, what this money is going to go to, other than it's more productive. But they're going to funnel this to other areas of the economy they deem to be more productive. So there's a lot to say here. Of course, we've seen it in practice, like SIFMA mentions. People are going to widen out their spreads because that's what happens, because people are going to trade less because they're getting hit for 10 basis points every time they're going in and out. So it sounds simple. Oh, you enter a trade, you exit a trade, but that's going to happen all day long. So, and also all this, we've seen this before in other markets like crude oil when things got very high, bills proposed to try to limit speculative activity. Guess what? The speculators out there are the ones who are taking the other sides of your orders more times than not. So these big firms that are quote unquote engaging in speculative activity, and yes, there is some dubious stuff out there, and we certainly want to focus on that and highlight that. But in general, most of this quote-unquote speculative activity that you term is actually what's backstopping your orders and providing a lot of the liquidity, particularly in these days where the big market-making liquidity firms have mostly gone the way of the dodo. So it's to notion that you could just tax these things and then you're going to maintain all this liquidity and everything else that you need is kind of a, shall we say, a dated prospect. But I could talk on this at length, but I'll let you guys weigh in. Maybe we'll go the other way. Matt, we'll start with you. All sorts of interesting language in this. What are your thoughts on this latest attempt to impose a transaction tax on options and everything else?
Yeah, this is just another example of just some clueless people thinking that they can control behavior through taxation, which I'll call violent taxation. A couple things come to mind. One is, this is a tax just like the taxes of market data costs, which I think are far too high. So I think the same logic that SIFMA has about adopting these taxes, they could apply these to adopting high market data costs, which is in effect a tax on these markets and creating less liquidity. So, I'm finishing this book called The Tao of Trading by Spitznagel, and it's a very interesting book. It talks about the Austrian school and how they talk about market equilibrium and all these taxes are doing is just creating unforeseen trouble in an economy and dislocations. So I think SIFMA is right in a sense that they're going to just move to other markets, or people want to apply their trade somewhere. So they're just Frederic Bastiat is an economist that talked about the unforeseen costs well, I think there are going to be a lot of unforeseen things that happen if they were to put this type of tax in. And they always say it's going to be just this little bit, and then it kind of grows and grows and grows. So, yeah, hopefully they'll do the right thing and not do this, Mark.
Yeah, it's we've seen these come before. I don't spend a lot of time. This one seems a little bit more well thought out and has a little bit more muscle behind it, which is why I wanted to address it. Hopefully, this one's going to die on the vine too. It always cracks me up with any type of these types of taxes. The people who do them really have very little understanding of how these types of bills and these types of taxes impact behavior. And so they just kind of do the math like they did here. Oh, here's the volume we've seen over the last few years. Let's just multiply it out for the next 10 years. This is how much we take a percentage of it. Okay, that's what our revenue is going to be for the next decade, without realizing that the tax is going to change the way people do things. A good example, not a transaction tax, but something similarly out of left field. They tried to input a soda tax, a sugared beverage tax in Chicago a few years back, and they anticipated all this revenue coming in because they just looked at all the money people were spending on soda in Chicago and multiplied by the percentage. Here's how much money we're going to bring in. In truth, what happened? There was all sorts of loopholes in it. First off, people bought less, so they bought it outside of the area where it was taxed, so that revenue fell quite a bit. And on top of it, they had all sorts of loopholes in there for things like LaCroix, which for some reason, wasn't taxed. So what happens? You go to the supermarket, you just see carts full of LaCroix everywhere, and everything else was sitting on the shelf. And so what you ended up having people spending the same amount on different things that were tax incentivized, and the revenue fell to a pale shadow what they anticipated. I'd imagine something similar would happen with this. So all sorts of things to unpack, but we'll keep on rolling here. Hopefully this one, we won't have to talk about it again. Hopefully it'll die on the vine there. But in case it does, we'll keep an eye on it as we keep on rolling into your questions and hang out our shingle for the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, welcome to the office hours, the portion where you guys take the reins. Lots of great questions coming in from you guys. Maybe we'll do another whole question episode too, because you guys take us off in all sorts of interesting directions. This one comes first from Andrew Dodson. I believe he's referring to a conversation we had a few episodes back about gamma scalping. He says, let me see if I have this straight. And it goes RE, delta hedging, or quote, gamma scalping. And he puts in parentheses, even though I'm not sure why it's scalping gamma and not delta. But I digress. Let's say you buy a straddle with a long 10 delta. Then the underlying rallies 1 point, so you sell 10 shares to make yourself flat again. Then you wait to see if the underlying drops again, so you could buy back those 10 shares at a point lower. Is that the gist of it? What do you do if, here's the interesting question. What do you do if the stock continues to rally and you continue to get long deltas? And why the heck isn't it delta scalping? If it was gamma scalping, then you'd be hedging the rate of change of your delta over that 1 point swing in the underlying, as opposed to the delta itself. All sorts of interesting questions. We have a great audience here. Maybe Chris, the director of risk, we'll start with you. Walk him through, is he correct or is he not correct on the gamma scalping? And then I like his other question, why isn't it delta scalping? I don't know if you know the answer to that one. If you do, feel free to weigh in. And then also the corollary to it, what do you do when the underlying moves beyond your anticipated range, right?
In a nutshell, he's got it right here. I mean, if you start off with a long 10 delta straddle and the market rallies up, you will still be at least long 10 deltas. You may be a little bit longer because long straddles, if you're long gamma, it manufactures what I call our good deltas. So if the market goes up, you're going to get more positive. If the market goes down, you'll get, in this case, less positive and eventually actually negative delta. So he's right about scalping the deltas. Why it's called scalping gamma, I have no idea. I don't know where that came from, and it's just something that's stuck, and that's kind of, I guess, because the deltas are changing because of the gamma measurement, which is the second derivative. But you're right. I mean, we're actually scalping deltas. I think you wanted to take it to the next step is how do you actually scalp those deltas? Because remember, you can scalp them versus stock, which is just going to be pure delta. But if you want to actually increase or decrease your gamma exposure, you can scalp your deltas by trading options as well.
This is another reason why options trading can often be intimidating to the newcomers, is because the terminology is somewhat opaque. And as Andrew rightfully points out here, Matt, I know you devoted a lot of time when you were on the floor to your methodology around, let's call it delta scalping for the sake of Andrew here, just because it's a fun question. What are your thoughts on his question? Obviously, the systems tend to have trouble when you start getting beyond your ranges, which is his other part of his question. And then if you know the answer to why we call it gamma scalping, have at it, sir.
Yeah, so I backed a bunch of traders, and we talked about this all the time. And the reason you call it gamma scalping is if that's true that you're covering your deltas, but if you look at your positions and you have zero gamma up and down, you're not going to be scalping anything. But if you have gamma, as the stock moves, you're going to be able to sell or buy, as Chris says, good deltas. So that's why we would look for how much gamma that you have, and then you would, what's called scalp is just cut down the amount of delta that's growing or decreasing as the stock moves. So you always look at your gamma to know what stock's going to be scalpable. And we did this quite a bit, and we came up with rules like for particular stocks. And we would back test based on one-way moving stocks, where you would let the what we would call let the deltas run. You wouldn't scalp as much, if that makes sense. So you would, like an IBM, you'd let it go because it would often make we would calculate what was the best amount in dollar terms to let that go. So it might be a $3 move, whereas I traded Nextel, which was a NASDAQ stock, and we were gamma scalping, so to speak, intraday. So it would move 50 cents. We'd sell some deltas, and then we'd flatten out there. If it went another, and that's the type of stock that would then turn and go the other way, just based on the wind or whatever, and often close close to its opening. So that's how I would explain it to Andrew, and just know that it's probably not as applicable to traders, to retail traders, but it's very applicable to market makers and those with bigger positions on, Mark. Yeah,
certainly market makers, liquidity providers, definitely fund managers who might pay attention to this. And you're right, I feel your pain, Andrew, because the thing you're actually trading to sell and hedge is the delta. That's what you're trading, right? But the thing that makes that delta change is the gamma. So as Matt alluded to, if you just have this 10 delta and nothing else, a 0 gamma, it would stay 10 and nothing would really happen. So you need that gamma to make your delta fluctuate, which is what you're effectively hedging. So that's why it's a little confusing. The thing you're actually trading is the delta, but the thing that makes that change is the gamma. So hence probably why it's been termed gamma scalping. And you're right, it does change on the underlying. I remember when I got out to Intel, I used to have to scalp it very aggressively throughout the day because it wasn't a big mover until it did. Then it would run. So it was a challenging art in and of itself, outside of all the fun that went into actually making markets and options. You had to actually do this other thing, which was actually going to pay for a lot of that, which was interesting in and of itself. All right, we got some meaty questions. Maybe we'll save those for a question spectacular here. We got another 5-star review. Comes from Andrew. Another Andrew. 2 Andrews today. Andrew run today. He says, fantastic shows. Just do it. Mark is great. Well, thank you, sir. I think that came from iTunes. I'm not sure. Thanks for the love. There, keep them coming. If you like what you're listening to, head on over to your platform of choice. Give us some love there. We won't hold it against you. Maybe if it's fun, we'll read it on the show. Let's see. Let's wrap it up on this one. This comes from Kevin, or maybe Kevin G. Either way, I'll go for Kevin G. He wants to know, why doesn't anyone put out the earnings straddle analysis similar to the analysis from the so-called analysts? Then we can all fixate on whether a name outperforms its straddle as opposed to beating the whisper number. I think that's more valuable. Why don't more people know about this stuff? Well, Matt, this is certainly right up your alley. I like to think that we're getting the word out there now. We're putting it out there on the site. We're putting it out there with the earnings move results reports. So certainly more people are becoming aware of this concept of the price of the straddle and what it implies for the movement in the underlying around earnings. But I'm with you there, Kevin G. It would be nice to see more people out there instead of talking about here's the whisper number, here's the analyst estimates, here's what the market is actually pricing in. Forget all that other nonsense because those guys don't have a clue. Here's what the market's pricing in. It's by far and away the best predictor of anything. And talk about that and whether it's beating that. Matt, I know you're probably on that train as well. What do you have to say for Kevin G here? Why don't more people know about this stuff?
Yeah, I have a couple thoughts. One is it's a difficult art. So you have a straddle price, and let's just say there's 10 days to earnings, and you have to figure out and maybe 20 days to expiration. So you have to figure out what amount of that straddle is applied to the earnings move. And that's what we do. We put out that information so that, if I would just say go check it out on the Option Insider blog, you could see a lot of those numbers that we've extricated the move that has to do with earnings. And those are we found out, for thousands of stocks that those are quite accurate predictors, like you said. But there are also what we identified, and I mentioned earlier, we didn't have a very good, it's kind of a break even quarter, but often these quarters are pretty good. We have some methods for identifying what stocks are going to do well, and that are kind of hidden in the reading the tea leaves, so to speak. But one of the things is when you take out that earnings effect, you're left over with an implied volatility. So you mentioned Intel. So Intel, let's just say, is about a 25 vol stock. Well, if there's earnings coming up, the volatility might go up to 30, and then next month might be 28, and next expiration, might be 26. And then so if you then take out earnings by coming up with a rational earnings effect that you would apply to each month, you could then have that term structure fall to a rational level. Now, sometimes that term structure falls to a backwardation where the front month is above the back month. I know that's a little complex, but that's one of the signals that we look at. Is the underlying volatility in backwardation or in contango after you take out the earnings? So, Kevin G's question is, why don't more people know about it? It's pretty complex, and it's a tough thing to do. We put it out there, and we have a few, definitely some people that do very well on earnings, but it's a difficult trade. It's a difficult trade to do, and you have to really dive into the numbers, do quite a bit of math, do quite a bit of modeling to really be successful, Mark.
Well, that music means, unfortunately, we've come to the end of another epic journey through the world of advisors and options. Talked a lot of fun stuff, some scary stuff with some bills. Talked about iron versus iron, answered some of your questions. All sorts of fun was had on the show today. But before we go, let me go back around the horn, check in with each of my cohorts, see what they have cooking that may interest you. Let's start with you, Chris, because I know you guys at Swan have a lot up your sleeve. You got the website, you got the newsletter, you got all the white papers coming out, and in addition, you got something big coming up pretty soon. So why don't you explain to us all what that is?
Yep, always busy. We just released a new white paper by Mark Otto called Avoiding the Big Blow-Up, Why Option-Based Strategies Fail. Takes a deeper look at leverage, liquidity, risk controls, and option-based strategies. And as you just mentioned, we are preparing for our RIA forum in Chicago. That's going to be held April 28th to the 29th. And you can get more information at swanriaforum.com.
There you go. You can see Chris in person, live and in person on some of the sessions. So if you have questions you want to ask the director of risk in person, and hey, who doesn't? Then check it out over there at swanglobalinvestments.com. I'll maybe even be there too, so it'll be all sorts of fun gathered together there. Coming up next month here in, should be much warmer, much more sunny, Chicago by then. And Matt, we were just talking earnings data and all the work you guys put into it. It's pretty cool stuff. If people want to check out more about what you guys have cooking, where should they go? What should they do?
Yeah, come over to ORATS.com. We're continuing to blog pretty heavily, a lot of good educational content. We also have some new improvements to our backtesting form and the functionality there, so we're excited about that. We're going to start doing more signals analysis, so we're going to go out from just a regular option traders to option traders, but might be just in long short funds to stock traders. So try to get our option information out to stock traders. I'm actually going to be discussing some of this at the Option Industry Conference in May. I'm going to be speaking there and talking about some of the ways that we generate volume, and that is one of the ways to get in. You start these people that don't really trade options, start them understanding the information that you could get out of volatility and utilize in their models, and then they start to get more familiar, and then they start to look at actually trading options, and ORATS is there to take them through that procedure. So that's what we're excited about. So it's orats.com, and come on over.
Check them out, and we'll also have the panels coming at you from OIC in a couple of months as well, so we'll give you a chance to listen to Matt's sage advice on the world of options when that panel goes live as well. And speaking of panels and events, I was just down at the FIA conference last week, had a chance to have a good chat with our friend, Mr. Eric Cott, who runs the advisor team over there at the Options Industry Council. Once again, traveling hither and yon, couldn't join us on the show today, but he did say a lot of cool stuff is coming down the pike from those guys, so stay tuned to optionseducation.org, including, I'm excited, a little bit scared to say as well, a new show on the network featuring Mr. Cott called Coffee with Cott, aimed at this exact audience, the audience of advisors out there who are intrigued, shall we say, by options. So stay tuned, stay glued for that, hitting your network wherever you find this show. Should be coming in the next week or so. So stay tuned. You can't miss it. It's going to have Eric's face all over the cover art. So it'll be inescapable. Coffee with Cott. Keep an eye, or shall I say an ear, out for that. And on behalf of myself and Matt and the Director of Risk and our friends over there at OIC, I want to thank all of you out there for downloading and streaming and subscribing to the show. Of course, sending in such great questions. Keep them coming. And we'll see you next time for more of The Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.